Every single year, our money is losing value in the bank. You deposit your money in the bank, you think it's safe. The bank is taking that money that you are saving, lending it to other people, making 10 times that amount of money, while your money is actually losing value in the bank every single year. So in this video, I'm going to tell you guys exactly how you can combat this so that your money does not lose value in the bank. So stay tuned. What's up everyone, my name is Ntombela and welcome to my financial education channel. So in this video, I'm going to be explaining some tips and tricks that you should think about before you start investing your money, especially as a beginner or if you're someone who just started investing your money, right? So just as a disclaimer, I'm not a financial advisor. I'm not trying to give any financial advice to anyone. I'm just a random guy on YouTube who's giving out their opinion on different matters, right? But that being said, let's jump right into it. Now, don't get me wrong. I'm not saying that you shouldn't have an emergency fund. In fact, I recommend that everyone have an emergency fund, which is money saved up in case of emergency, because you don't know what's going to happen in the future, right? So I definitely recommend that everyone have an emergency fund. Once you have your money saved up in your emergency fund, you should definitely start to invest your money. Invest it in what? Income generating assets. There's so many different types of assets you can invest your money in, and that's where you should definitely, without a doubt in my mind, start doing. Because your money is going to lose value in the bank if it's just sitting there the whole time. So invest. So please make sure that you do stay till the end of the video, because at the end of the video, I'll be telling you guys what I think the best investment you can make in 2020 is, right? So the first thing you need to do when you want to invest is to pay yourself first. You really need to pay yourself first, otherwise you won't have anything to invest in. So the concept of paying yourself first is not new. It's not one that I'm magically coming up with. It's something that's been around forever and ever. Like, what you do here is, on your monthly income, on a monthly basis, you decide on a percentage starting at 10%. So at least 10% of your income that you're setting aside, you're saving towards investing, right? Every month you religiously do this, otherwise you won't have any money to invest. So there's no point in saying, what do I invest in, if you don't have any money to invest? So we all know who Warren Buffett is, right? So he says that people who say cash is king, those people are crazy. And it kind of makes sense, because in 10 years time, the value of the rand is going to be less than what it's worth today. We've seen that throughout the years with inflation, right? So get out of cash and get into income generating assets. Invest in businesses and invest in assets that will generate you an income. Now, how do you do this? I know Warren Buffett says that you should always look at an asset and say, if this asset were never quoted again, would I be happy with what it is generating me? So that is the cash that is generating you, whether on a monthly basis, quarterly or yearly. Would you be happy with those cash on cash returns as compared to buying gold, for example? If you buy gold, yes, don't get me wrong, gold is a valuable asset, but gold just sits there and looks shiny and looks pretty, and there's actually no income that you're generating from it. Rather buy land to the value of the gold that will generate you an income from maybe farming, whatever business that you can start from having that land. It will generate you income, and not only will it also appreciate in value, but you're not banking on appreciation, right? You purchase the asset for its cash flows, and whenever you decide to sell or whatever you decide to do with it one day, it would have appreciated, and you can use that appreciation to your advantage. The next thing you need to do before you invest is to do research, right? You need to do a qualitative assessment, you need to do a quantitative analysis. So a quantitative analysis basically refers to the numbers. Look at the financial statements, the income statement, the balance sheet, look at the different ratios that are available to you. These ratios are easily available, or you can calculate them yourself using the financial statements. And one of the popular ratios that are used is the PE ratio. So I want to give you guys a quick example of a quantitative analysis. This is not a full quantitative analysis, but this is the type of thinking that you're going to go through. I'll be using the PE ratio as an example, right? So when you're trying to purchase a stock, you want to purchase a stock at a discount. So what does a discount mean? It means that you're purchasing the stock. This is the price at which you purchase it at, and the price is less than the value. The price is basically whatever the stock is quoted at currently in the market. Now, getting the price of a stock is very easy. You can practically just Google it and you'll find whatever the price of the stock costs currently in the market, right? The issue comes when you have to get the value of a stock, because the valuation of a company will differ from every individual. I can value it at a different value using my own valuation metrics, and someone else can come up with a different valuation. But for today's example, I'll just be using the PE ratio. So you in essence want to buy a stock that is less than what it actually is worth. So the cost must be less than what it's worth. So when does this happen? This happens easily in a stock market crash. As we've all seen, there's a lot of stocks that have gone down 50, 60, 70% in value in the past couple of months. This is due to the pandemic, unfortunately, that companies weren't receiving an income. But maybe the market kind of overreacted to that, because you see some companies that are really good companies that are down 70%. So now you look at it, you look at the price versus the value, and you see that the price in this case might not be equal to the value. So the opposite of this does happen, guys. It does happen that the price of a stock is actually more than what the potential value of the stock could provide, right? This happens when people get really excited about a stock. They believe that this company is going to be so big, they're the future, this, that. So many people believe that, and then it pushes up the stock value and inflates it to a price where it's actually not equal to the value anymore. So then this is when you definitely are trying not to buy those kind of stocks. No matter how much hype there is behind it, that's the stocks that you really need to stay away from. But anyway, let's just get into the PE ratio. So the PE ratio is really a metric that is really pushed by earnings. Earnings meaning profits in this regard, right? So the earnings of a company over the past 12 months divided by the number of shares in the company will give you the earnings per share. So let me just draw that out for you guys quickly. So the earnings per share is equal to the profits divided by the number of shares. So let's just assume that a company has made a profit, right? Made a profit and of 200, and they've issued out 50 shares. That means we'll have an earnings per share of 4. So your earnings per share in this example is actually the basis of the value that we're going to be using for this company. So now that we have our earnings per share, let's actually get to our PE ratio. So assuming that the price of the stock is equal to 32 rands per share, our price to earnings ratio will easily be calculated by saying 32, which is the price, divided by 4, which is my earnings per share, giving me 8. So my PE ratio in my example is 8. So now you need to determine, is the PE ratio of 8 a good or bad PE ratio? Does it mean I should buy? Does it mean I should sell? So looking at investors like Warren Buffett, he says that a PE ratio of 8 would be a good time to buy. He says that a PE ratio that is less than 10 shows that the stock is undervalued and that this is a good stock to buy. Warren Buffett further goes on and says that a PE ratio of 15 is still fairly priced. It's still okay for you to buy. Then when it gets to a PE ratio of 20 and above, that's when the price is now over. That's when this is now the other way around. The value is less than the price. That this stock is actually overpriced. And then when it starts to get to a PE ratio of 30, that's now clearly a bubble, and stay far away from that stock. And if you own that stock, sell. That's what basically it's saying. So using Warren Buffett's analogy of a PE ratio greater than 30 being a clear bubble, you look at companies like Amazon, right? Companies like Amazon I think they have a PE ratio of over 100. So clearly that's a huge bubble. That's a massive bubble. But some people might be able to justify why they have a PE ratio that's so high, because people believe that Amazon is the future. Amazon is going to take over the world. Amazon is everything, right? So it really is a subjective calculation, and you need to do your own due diligence to figure out whether this is an investment that you'd like to make or not, because another investor might decide that's too much for me, or they might actually see value irregardless of this metric, the PE ratio, which is why I'm saying when you do invest in stocks and you're doing a quantitative analysis, you need to look at more than one metric, look at the PE ratio and look at many other different types of ratios as well to determine whether the stock is of good value for you. So that was an example of a quantitative analysis. However, numbers sometimes do lie. So you always need to work hand in hand with the qualitative analysis, which is when you're looking at who are the leaders of the company, what are the plans of the company for the future, and also what does the company do? There are some companies where you know that, no, this company is not going anywhere anytime soon. They've been here for years and years and years. So you need to look at the qualitative side of things as well, not only the numbers, because the numbers, yes, they do tell a story of its own, but they don't tell the complete story. And to have a complete story, you need to have the qualitative analysis with the quantitative analysis so that you can make a good investing decision. So I know that was a bit of a mouthful, but we're back to basics again. And tip number 4 is to invest in things that you understand. So when you're starting out investing, you need to invest in products and brands that you understand and use. So walk around the house, walk around the office, and look for brands and products that you use on a daily. And those are the products that I would recommend that you investigate the share prices of and see whether if there is value there for you to invest. And if not, then you can choose not to, but that's where I would definitely recommend that everyone starts. So the next tip is to invest on facts and not emotions. Because as soon as you find yourself saying, but I feel like this, no, that's when you definitely are going to make the wrong investing decision, because you're investing on your emotions. So guys, let's not invest on emotions and let's invest on facts. What are the facts? What is happening in the market currently? What is happening to that business? Is that business a going concern? Do I see that business running for the next 5-10 years? If not, maybe don't invest. Don't invest on your feeling of, I have a gut feeling that this company is gonna recover, and you have no facts to back it up. There's no numbers to back it up. There's nothing in the news to back it up. So guys, let's not invest based on our emotions, and let's always use facts when we're investing our money at all times. The next tip is to go for it. Opportunity waits for no one. So if you identify an opportunity, take the opportunity. The goddess of luck is not going to come back 5 times a year, many times in a lifetime. So take the opportunity when you have done your quantitative, qualitative analysis and you've done your own research and you feel like this is a good time to invest. Make the investment. Do not wait for anything, because if you do wait, you might miss out on a great opportunity. I can't help but quote Warren Buffett on this again. He says, don't sell. And I agree with that, because if you sell, you're likely selling because of emotion. You're then being an emotional investor. Don't sell the shares that you have purchased, because not only are you going to attract capital gains tax, but you're now losing out on potential value for the future. For example, if you had put in $1,000 in dollars this time, if you had put in $1,000 into Warren Buffett's company when he started it, today it would be worth over $17 million from just $1,000 a long time ago. So invest for the long term and don't sell just because maybe things aren't going well in the market. Don't lock in your losses, because if you do lock in your losses, then there's no way to recover those losses. So rather just keep it and wait it out, because the market always does recover. Don't sell your stocks. Invest for income and don't invest for quick returns. It's not a get-rich-quick scheme. Unless you are a day trader, then that's a different story. But the investing that I'm talking about is long-term investing. Next up on my quick tips is to diversify your portfolio. If you diversify your portfolio, if one industry is not doing too well, then another industry might be doing well. You don't want to keep all your eggs in one basket, right? So definitely recommend for you to diversify your portfolio. Start with what you know, and then you can start to expand your portfolio into other aspects as you grow as an investor. So I hope you guys have realized that you don't need an MBA, you don't need to be Albert Einstein to invest your money. All you need to do is to do your due diligence, do the research about the company, and then invest your money for the long term. Go have a cocktail on the beach, subscribe and hit the like button. You just need to live your life and forget about those stocks for a little while, because you are investing for the long term, right? Now, I'm not saying dump your money there and disappear for 10 years. Definitely, that's not what I'm saying. But what I'm saying is don't be watching the stock on a daily basis to see, has my money increased? Has it decreased? What's happening to my stock? Because that is going to drive you crazy. Trust me, I've done it and I'm still trying to get out of the habit of doing it, because it does drive you crazy. So if you've made it this far into the video, I did promise that I'd give you guys the best investment that you can make in 2020, And in fact, to be honest, it's the best investment you can make ever in life, regardless of what year it is. And it's not investing in property, it's not investing in stocks, it's not investing in currencies or Bitcoin, none of that nonsense. The best investment you can possibly make is to invest in yourself, right? The reason why I say this is because when you invest in yourself through the form of attending seminars, getting mentors, reading books, using platforms such as YouTube and listening to random guys like me, you can actually make better financial decisions for yourselves. You can learn so much, and the cost of learning is actually so low. It's not like getting a degree. Getting you a degree can cost you 200,000 to 300,000 rands, but I'm not talking about that type of education and investing in yourself. I'm talking about something more than that. I'm talking about reading, getting yourself a mentor at work or outside, attending business events, those type of networking events, and those type of lessons you'll learn in the real world and from other people's experiences are invaluable. So definitely invest in yourself, and by investing in yourself, you'll stop watching idiots like me on YouTube teaching on how to invest for beginners, right? So basically what I'm saying is invest in yourself, and the return you get from that will completely be infinite. So thank you guys. If you've made it to the video this far, hit the subscribe button, like the video, and I'll see you guys on my next video. Cheers.